In this video, we're going to explore some of the other costing techniques which can be used and are used by some businesses either alongside marginal or absorptional or activity-based costing. So these costing systems can include specific order costing. So this can be used when work completed consists of separately identifiable jobs or batches. So for example, any customizable product business that may exist isn't necessarily always going to produce the exact same item. Or it may be a continuous costing approach that is used. So this will be used if similar products or services are going to be produced as a direct result or consequence of a sequence of continuous operations or processes. So for example, that could be a hair salon. So they offer very similar services. However, each client may require a different type of hairstyle, different type of haircut, different work needs doing. So costing methods then. So first of all, we have job costing. So this is a specific order costing form. It is used where production is made up of many individual jobs and individual cost units are identified to each customer's specifications and requirements. So some business examples that are mostly likely to use job costing then are construction firms, builders, plumbers, accountancy firms. Batch costing is the next one. So this is another form of specific order costing, and it is for businesses that produce batches of identical costs. It can be calculated by doing your total batch cost divided by your number of units in the batch, which will give you the cost per unit for each batch. So a good example of this is if you think about a bakery. For example, they will produce a dozen of bread buns or however many in a batch. Thus, they are likely to use this method. Next up is service costing. So this is a form of continuous costing. It is very difficult to establish a suitable cost in unit costing. Overheads are likely to make up a much larger proportion of this cost as opposed to direct cost. Ultimately, it is a service rather than a product. So we do the total cost of actually providing this service divided by the number of service units used to provide the service in order to arrive at our cost per unit. So an example of this would be a school working out the cost per student. Next up is process costing. Again, another form of continuous costing. It's suitable when goods or services result from a sequence of continuous or repetitive operations or processes. And it will be used when items are being mass produced and the item goes through several different stages. So if you want an example of this then in real life, it could be paint industries, textiles, chemical, oil. Essentially, they are checking at every stage that it is basically okay and that it meets standards. Joint product costing then, what is it? Well, essentially it is a process costing, which means that the process incurs joint costs. More than one product will be produced before being separated for sale or for further individual processing. It is split into joint products as well as byproducts. Joint products will be the main product, while byproducts are incidental to the main products. So, joint products. Two or more products separated in processing, and each product is sufficient to be sold separately. Byproducts, on the other hand, are outputs of value produced incidentally in the manufacturing product. So, for example, sawdust becomes a byproduct within the timber industry. Essentially, the goal is for wood to be sold, timbers to be sold, but the sawdust is essentially a cut-off in itself. You may be able to sell it, But essentially that is only a byproduct. It is not the main product the business is trying to sell. How do we account for joint products then? Well, we can do this through physical measurement. So joint costs can be apportioned to the units of output of each joint product. Units of measurement for products should always be converted to express the same, whether that be kilograms, stones, litres, etc. There should be a technical estimate of usage which can actually determine each product within the organisation. We then have market value. So this is where joint costs are going to be apportioned based on the market value of each joint product at the point of separation. At that point, each product should appear equally profitable. It could be done via net realisable value. So to do this, further processing costs can be deducted from market value prior to any joint cost being apportioned. Accounting for byproducts then. So sale proceeds from the byproduct can be treated as simply just profit, or handling and selling costs can be deducted from the sales price in order to reduce the main cost of the product. Throughput accounting then. What is throughput? Well, it is a technique where the primary goal is to maximise throughput while simultaneously maintaining or decreasing inventory and operating costs. So a few key facts about throughput accounting then. It is a measure of profitability. It can be calculated by deducting any material cost from sales revenue. Throughput aims to maximise the measure of throughput contribution. However, there are a few things that throughput does assume, so it's not always the best method for businesses to use. So it assumes that direct material is the only variable cost. Direct labour cost will not be assumed to be variable, and all other costs except raw materials can be referred to as total factory cost or operating expenses. Thus, throughput can be seen in the same light as that of contribution. Investment then. So money which the business intends to invest and buy things to then sell on for a profit. Money needs to be tied up in assets to allow the business to make throughput, and this will include any raw materials, any work in progress, any unsold finished goods. Operating expenses then in relation to throughput. Well, all money which a business spends to produce throughput and costs which are not totally variable, so they may not necessarily be fixed either. Profit reporting then. If you're asked to calculate this using the throughput method, you can do so quite easily. So you would just deduct your raw materials from your sales revenue in order to get your throughput contribution. At that point, you can then deduct any remaining operating expenses in order to arrive at your net profit figure. We can also invent our inventory valuation using throughput accounting. So if we do this then, inventory should only be valued at the purchase cost of raw material and bought in parts. No other costs should be included in this figure. They do not add any value at any point until that item is sold. Multi-product decision making then. So as long as customer demand can be met, the business should always produce enough to meet consumer demand in full. But if the business has a constraint which prevents customer demand from being met, there is going to be a bottleneck in place. In other words, a limiting factor. Thus, if this is the case, the business must prioritise the demand for which has the highest contribution. They are essentially making the most money from that product. So an example of a bottleneck then could be that you don't have enough labour hours or perhaps not enough raw materials. Steps for dealing then with a multi-product decision. So first of all, you need to identify that bottleneck. Second of all, your throughput contribution per unit for each product needs to be calculated. You then need to do it for each product in order to be able to rank the resources that you have and rank the products so that you can allocate the resources that you do have to the highest earners. So obviously there is some accounting formulas that you do need to be aware of when dealing with throughput accounting. So here we go. The first one that you need to know is how to calculate the throughput accounting ratio. So we can calculate this by doing our return per factory hour divided by our cost per factory hour. However, we need to be confident with how to calculate both those figures. So first of all, we need to know our return per factory hour, which can be calculated by doing our throughput contribution divided by our product's time on the bottleneck resource. You then need to know how to calculate your cost per factory hour, which again is going to be total factory cost divided by the total time taken on the bottleneck resource. So explaining this then, so if the ratio is greater than 1 when you calculate it, it is likely that the product will be profitable, as the return should exceed any operating costs. If the ratio is less than 1, it is obviously the opposite, and it's probably going to be a loss maker. The return is going to be insufficient to cover all your operating costs, and ultimately, as a business, you need to decide whether or not it is worth continuing with that product. Issues with throughput then. So it's not the best, it's not the worst. It has some issues, as do all costing methods. For starters, it only concentrates on the short term, looking at fixed supplies of resources and mainly fixed operating expenses. It can be very difficult to apply to the longer term, especially when all costs are variable and the production varies a lot. And one of the final things that we'll touch on in this video is costing digital products. So this is something very present, it's something very new still to the accounting world. So why are digital products more difficult to cost? Well, to put it simply, cost drivers for overheads can be very difficult to work out. The lifespan of a digital product varies significantly. As you will see in the digital era, nobody can predict how long each bit of software is going to last. It could be that a simple update is needed, it might be something more complex. Often there is going to be no standard time or cost which can be attributed to a digital product. Therefore, the finance function must try to work out and try to absorb costs into individual products when a lot of features will be shared amongst many products. In this scenario, marginal costs are often very slim, as costs are likely to be mostly fixed in their nature. So there is a few limitations there. However, there are also some benefits of using this, and this is the final thing we're going to touch upon in this video. So the good thing is it's real time and it has up-to-date information. We have access to more resources. We have a better understanding of our costs. It can lead to reduced operational costs, and it also allows for improved communication, as well as being able to make quicker decisions because we've got that improved communication there. It can also lead to a greater accuracy of costings because we're actually keeping up to date with it, which in turn would improve your cost control. So there are many benefits to having that digital cost system instead of being paper-based.